up ahead. Affirmative 612.
Back for another edition of the Wealthy Pilots Podcast. Scott, my friend, let's talk about the hidden risks of market-based cash balance plans. That's a mouthful.
Yeah.
So what are we talking about this week? And, I think pilots often hear like tax deduction and they just kind of go, sweet.
Yeah.
Right. So let's talk about these hidden risks.
Yeah. I mean, taxes are funny, right? So, I mean, this is a foundational part of the discussion when we talk about 401ks, non-deferred compensation, or non-qualified deferred compensation, market-based plans, healthcare retirement accounts, all that. So the one thing I always want to remind when we talk about a market-based plan, let's define it first. This is basically what we would call like a spillover account. A lot of the airlines have it. So, and they were developed because the contribution the company is making, and then many times just their contribution, but definitely after it's added to the pilot's individual contribution, will frequently exceed the 401k limit that the IRS has stated, right? It's like 73.
Okay.
So when those contributions get above that, they have to go somewhere. It used to just get distributed to the pilot in cash, which if I'm high earning, if I'm higher earning, I consider that over 400. If I'm high earning, I'm going above into those higher tax brackets. I'm also kind of hitting the level where my auto contribution from the company plus my contribution definitely are going to get me over those IRS limits. Well, maybe I don't want that money distributed to me right now because I'm in a higher tax bracket.
Okay.
And so it basically manifested in the company creating these other plans where, hey, we will create this spillover when the IRS bucket gets over full, it spills over instead of into your paycheck into this market-based cash balance plan to provide a little bit of extra tax deferral. Now, let's be clear, tax deferral is not the same as tax savings. If I reduced my tax, if I had 20 grand going in the market-based cash balance plan this year as an example, let's say 20K went in there. Okay. I did not save taxes on $20,000 of income. I just deferred it. Okay. So I did reduce my taxable income this year, but I still owe that. If we look at a balance sheet that I have, assets and liabilities, that's on the liability side. I'm going to owe that tax later on. Hopefully I'll be in a lower tax bracket in retirement. And that will be the case for, I think of many of our higher earners, that will be the case. So they're not inherently bad, but I do think there are some, kind of hidden risks. Okay. One of these is on this topic, on the tax deferral. You are continuing to kick the can on taxes. You are continuing to increase on my personal liability sheet, assets and liabilities. I'm continuing to increase the liabilities, right? And enter basically a contract with the government that I'm going to give them this money later.
Mm-hmm. Yeah.
Also in that market-based cash balance plan, the total tax bill is probably going to be higher. If I put 20 grand in there, and not necessarily from a percentage standpoint, but from like a dollars standpoint. Okay.
Okay.
Right. And there's a lot of times, Mark, I look at it as the cash more than I do the effective tax rate. Right. So, okay, if my effective tax rate is lower in retirement, I might feel good about that. At the end of the day, if that 20 grand grew into 60 grand, I'm going to owe it. Let's say I owed 30% on the 20. Okay. That was a $6,000 tax bill, but I defer it all. It grows over time. And now that 20 grand contribution is worth 60 in retirement. And I owe 20% on it. That's 12 grand. So yes, I paid a lower tax bill. My effective tax rate is lower. However, my tax bill doubled in terms of cash. And so we want to be very conscious of what our tax roadmap looks like, what our income roadmap looks like, and our broader asset plan looks like. Because again, if we just keep kicking the can, even if our effective tax rate is going to be lower in retirement, the total cash dollars we're paying and the raw dollar amount could definitely be higher. So we want to be conscious of that. And again, I care more about paying the least amount of tax dollars as I can in my lifetime. Obviously within the realm of the legal, ethical, moral for sure. But I got to pay what I got to pay, but I don't want to leave.
Well, there's no reason to pay more than we have to, right?
Yeah.
So These things could get pretty complex. Is there some pros and cons that you kind of see as to like why they're, I mean, I know you've already highlighted some, but it feels like sometimes these things, I don't know, they just feel a little overly complicated.
Yeah. I mean, the major pro is we reduce our taxable income this year. That's
right.
That,
Again,
that to me that's
the tax
only,
benefits what we see and we go, oh yeah, let me just do that. Yeah.
That's the only pro I really see. Right. So if we look at the cons,
Okay.
I mean, that the one I just highlighted right there, we're kicking the can, and many times the total tax dollars we're going to pay is higher, even if the rate is lower. That's one. The other con, these are managed more like pension plans. They're not, you do not have flexibility or independent investment authority over these accounts. And if we look back in the last handful of years, they've grossly underperformed the broader market.
Okay.
And so, I was looking at it for one of the major airlines. It's delivered about half of the returns of what the market has given us. So again, even if I had to pay a higher tax rate on those dollars, if I could still get the cash paid to me after taxes, invest it in more aggressive investments with a long-term time horizon, I'm going to make up what I lost in taxes, and it's going to be tax-free, or at least after-tax dollars. And so, to me, I want to maintain the investment autonomy as much as I can with as much of my assets as possible. So that's another part of it.
Okay.
And then, the third part of it is the lack of liquidity, right? I can't get to that money if I wanted it for something, while I'm working. I mean, I'm not saying that we would necessarily recommend, we don't make a lot of recommendations to spend down a 401k if you need cash, but it's tied up. So I just don't want to tie something up into an account that I don't have any control over, that's, kicking my tax can down the road, and it's going to underperform the market. I mean, how many bad things can I put together in one here just to save a little bit on taxes this year? So, and again, it's not like people, for the most part, not that many people are putting, six figures into the cash balance plan every year. So it's not a huge portion of their income. But if we can, work on our contribution strategy where maybe I'm reducing my employee contributions and maybe taking the money I'm going to put in and put it into a separate account where I get less spilling over. Now I can kind of work within the boundaries of the system to bring more of the assets into my ability to manage them and, keep them in the accounts that I want to have them in, have access to them. And again, if I have an after-tax brokerage account that I'm investing in, let's say I'm putting $3,000 a month in there. Okay. I think it's going to start growing pretty good size and not very long, as long as the markets continue to do well. I can use those assets. First of all, I could borrow against those assets if I wanted to. Again, not saying I would recommend that, but you could without tax consequences. Second of all, I can liquidate some of those assets to go buy a home or pay cash for something. So again, I would just much rather have, I want the assets on my balance sheet. I mean, that market-based cash balance plan is a liability on the airline's balance sheet to pay me. No. I want them to be, I want to own them. I want the assets, as many of the assets to be with me as possible that I can access when I need to access them. And so, it's just, to me, you're just tying up more and more assets that you can't touch for a long time.
Gotcha.
So there's that aspect to it. So,
well,
now,
go ahead. I was just going to say, if we were talking about like the hidden risks, and you talked a lot about, it's like, is there like an absolute not, like this is not a good fit for somebody kind of thing? I mean, that's hard in finance, right? There's no absolutes, right? As far as like some vehicles work for some and not for others, but
I mean, I think for folks who like, hey, who definitely should be trying to use it.
Sure. Okay.
I think it's somebody who, for some reason, desperately needs to reduce their tax burden, right? If that's the case, yeah. I mean, you would want all your contributions going to pre-tax, and then you want all the spillover going to the market-based plan. And so if there was some reason that you really desperately needed to reduce your tax burden for that year, then yes, do that. But, for most folks, I'm just trying to think. I mean, for most folks, when we look at their plan, we're trying to get more of the assets to go, let's get the 401k maxed out for sure. But then outside of that, we want more of the assets going into their directed brokerage accounts than into the market-based plan. One, so they maintain the asset, they get the liquidity, they can do what they want with it. And then two, again, the performance of these has just been dismal. And
gotcha.
You
so the tax advantage is really not like you're not letting the tax tail wag the dog, right? Don't let it kind of suck you in because of the tax possible advantage when the performance maybe is not there.
I mean, taxes, again, taxes can almost become an emotional topic where,
oh, yeah,
I want to do all I can to reduce the tax bill because I hate paying it. I mean, dude, we pay every year. It sucks. I hate it every year.
Yeah. Yeah.
However,
and it's only probably going to get worse if we're being honest, right? I mean, we are in historical low tax rates, like it or not, we are, right? Even though there's all these other little ways they're taxing us. But at some point, we're going to get different administrations in. They're going to change the tax code. They're going to probably want to tax us out the yin yang to pay down some of the approaching $40 trillion in debt.
I mean, and that's where if I can look at the distribution of my dollars and say, okay, if I have 100% of my assets tax deferred, so much of this planning is about risk management, right? And if I got 100% of my assets tax deferred, I might be mitigating my tax bill this year, but I'm now living with unmitigated tax rate risk in my retirement plan for decades to come.
Gotcha.
And when I talk about tax rate risk, I mean, a new administration comes in or whatever, and somebody finally balances the budget and wants to reduce debt, and they're going to do it through taxing the middle class. You're going to see that really hurt people where, I mean, my tax bill could double through retirement and 100% of my assets are susceptible to that. If I'm at least diversified, I mean, again, in an ideal world for me, I got a third in taxable, a third in tax deferred, and a third in Roth tax free. If I could get to that third, it gives me a lot of flexibility and a lot of optionality based off of what's going on in the market, what's going on in tax law, and whatever the case is.
Yeah.
Again, I just, when you start a career working with high net worth retirees and you hear things over and over again, I wish I would have done more Roth. I wish I would have saved more outside of my 401k. Let's use some of those senior people's hindsight as our foresight and start working on that stuff now. And so that's where I think the market-based plan, they're not like inherently like evil or something like that, but I just think, when we look at the tax deduction as like this driving force for good, I think you're oversimplifying through a very, very short-term lens, something that, there's a lot of hidden costs that you don't see missed returns. You know what I mean? This is where taxes are so black and white for people. Like, okay, I was going to owe X and I'm owing Y, which is lower because I had money go to the cash balance plan. I like that because it was guaranteed savings. First of all, it's not savings, it's deferral. Okay. We still got to pay the piper. That's one. And we already kind of debunked that myth. You're probably going to end up paying more in total dollars, even if it's a lower effective rate. Okay. So we're probably going to pay more in dollars. And then two, what do I not see? I don't see the missed returns that I would have had if I would have just paid the taxes, got it into an after-tax account, and then grow it aggressively instead of letting it sit over in some, pension style managed fund.
Gotcha.
And so, again, I don't see those missed returns. If you take time to run the math and say, okay, let's say I'm going to do 20 grand in a cash balance plan for 5 years and with those tax deferrals and then run that out and see what I'm going to do. And then let's say I take that same 20, pay the tax, and I put 12 a year into a brokerage account that's going to grow at close to double the rate. I mean, at least historically, that's what it's been doing. What does that look like over the next 15, 20 years? It's a big difference. And, getting a little bit of data can help us make better decisions versus just taking the default option that the company's going to put in front of me. So,
yeah. And to your point, Scott, no financial vehicle is inherently, bad, except for maybe variable annuities. But anyway, none of them are typically, it's all about like, what's the tool that you need to accomplish the job you're trying to get done. Right.
Yeah.
And so that's where the analysis and the strategy, and building our wealth, and certainly through the last couple of years, whether you're DIYing it or whatever, accumulation is a hell of a lot easier than it ever has been before, as far as with the tools and the resources out there. But the distribution phase, AKA retirement, and getting ready for it, that's where the complication really comes into play, right? And that's where that strategy will come into play.
Yeah, and I think, when you look at somebody younger right now, a lot of the accumulation is going to happen. I mean, especially
it's
pilots. It's going to happen because
autopilot, for lack of to be cheesy, right?
Yeah, they so much of that is just set up to happen. And like if you do nothing, like it's going to go okay. Probably there's enough money getting pumped in and it's going into a target date fund and whatever. So, to your point, a lot of that's kind of happen automatically. But if we can think about what the complexities of retirement holds, and again, go talk to somebody who just retired. It's a lot different mindset. But if we can kind of glean and learn from them and apply that now to map out that future and then get a plan to work towards it.
Yeah.
And you're telling me like the more time on my side I work towards that plan with compound interest working for me, it's going to make a big difference.
Yeah.
It's going to make a big difference. So
well,
the sooner you can kind of get that vision and set it up and work towards it, the better it's going to be. Absolutely.
Yeah, I was going to say it's all about the analysis and the strategy building. So get onto the calendar with Scott, have some time, have a conversation. If you're a pilot with any of the, flying out there, or, you got a buddy who is, whatever, share the podcast with him, have a conversation, but get something done for yourself and your retirement. Reach out to him. You can find him online at retireairlines.com. That's retireairlines.com. A lot of good tools, tips, and resources there. Schedule some time to chat with Scott. Give him a call. Jump on the calendar. Whatever works for you, but take some action. Or check out the toolkit. That's a great way to get started as well. We're going to wrap it up this week, so stick around for the toolkit, but don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. And we will see you the next time. For Scott Osborn, I'm your host, Mark Killian. We'll catch you later on the Wealthy Pilots Podcast.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.